Fortunately, I live in a world where I meet with a lot of entrepreneurs. I talk to a lot of companies. I'm engaged at the board level with a lot of portfolio companies. And through that journey, different sort of observations, insights, perspectives, lessons learned come up. And honestly, X or Twitter is my means to have a journal to keep track of some of those. And some of those thoughts, I think, are relevant to lots of different companies, maybe every company. Some of those thoughts are more esoteric and probably not relevant to many folks at all. But I still jot them down because they mean something to me and I want to just keep track of them. So that's one set of contexts. So I also want to give you another set of context, which is that some of you know me from my public company work, which is with GameStop and Grove Collaborative. But most of my life is spent in the private company world, where at Volition, we invest in growth stage tech companies. They're typically in the 5 to 50 million in revenue range. And that's where I'm coming from for the most part with some of my posts is experience of young, growing private businesses, largely in tech. So you can have that context in the back of your mind. All right, so let's dive in. A couple of months back, I asked you which post did you want me to spend more time on. I went back and looked at those comments and I selected a few. So here's the first one that came to mind, which is I made this post a few months ago. It says overvalued top-line growth rate, undervalued top-line growth rate growth. And so the context for this post was, well, let me step back. The context is that as a growth equity firm, we love top-line growth. We love businesses that are growing. It's the clearest sign that there's a product or service that has resonance with customers. It's just that the business is growing. That is not complicated. So typically we look at companies that have very high top-line growth. Call it 80, 100% top-line growth, even much higher than that sometimes. The context of this post was we were looking at a company that was, in our world, growing somewhat more slowly, which is 20, 30% top-line growth. And I'll tell you, in the early days of my career, and I'm not even just the early days, for many, many years, I would say, why would I invest in a company with 20 or 30% growth if I could invest in a company with 100% growth or 200% growth? And it's because now that I think with more experience, there's sort of two different trajectories a company can take. And let me give you both. So imagine company A. A company A would be a more traditional company that we would look at and is growing very aggressively right at the start. So call it 100, 200%, call it 100% growth. So that is the current growth rate of the company. Then over a 5-year time horizon, let's just say it linearly declines from 100% growth to 30% growth. That's company A. Company B is the exact opposite. The current growth rate is 30%. And over a 5-year time horizon, it's going to grow. That growth rate is going to grow to 100%. Which is the better investment? Like, which one would you want? I would say many, many times the better investment might be the second of those two scenarios. The reason is because in company A, where the growth rate is high at the start, you have to pay for that. So you have to pay a high multiple of revenue or earnings to invest in that business because it's very clear, it's growing quite aggressively. As the growth rate declines, that multiple will contract. So over your hold period of that investment, you will experience multiple contraction. Company B, it's only growing 30%. So when you invest, the multiple will be lower. That will be reflected. And if it can grow it to 100%, then by the time you exit, it will have multiple expansion. And that can be an investor's best friend over time. And so obviously, the harder part about that is predicting when the company will grow from 30% to 100%. But nonetheless, if you have conviction that a company can grow its growth rate, that can be an investor's best friend because it means that you can have multiple expansion over the course of your investment. And you see that in the public markets in some context. Like if you look at Zoom as an example, Zoom in the public markets, when the pandemic hit, its growth rate exploded, right? Everyone was using Zoom for school, for education, for work, and so forth. And so Zoom the growth rate was growing, so the multiple expanded dramatically. And as you know, the stock price went from probably in the 50s to 550 plus. But then as the pandemic subsided, the growth rate declined. The company is still growing, but then the multiple contracted with it. And you saw that, you can see the stock chart right now, the company's market cap has dropped by 90% plus. And so in some sense, the best time to get involved with the company is when you think not that the company is just purely growing, but you think that the growth rate will grow, and that is what can drive value. And I think that's sometimes underemphasized in our world. All right, so that's the second one. That's the first one, I'm sorry. Let's go to the second one. And I'm being asked to silence my Slack, which I will do. Actually, that is my family slacking me, so maybe my family can stop slacking me so I can actually focus on my live broadcast. All right, the second post that is a very different topic. This is more qualitative. This post, let me read it. Consistency seems to be highly underrated. It deserves consideration as the preeminent superpower. Consistency seems to be the foundation of truly superior outcomes. Moderate strengths applied consistently, routinely outperforms elite strengths applied sporadically. All right, so the context of this post, if I think back, I probably interview
better trajectory
100 plus,
consistent.
This calendar year, probably over 100 people this calendar year. So I'm interviewing executives all the time. And there's always some sort of variant of what is your strength? That can be asked in different ways. It can be as direct as what is your strength? What are your strengths? Or what did your last review show as in areas of strength? Or what do you feel like has been disproportionately impactful on your success? Or a more common way now is what is your superpower? And that question I've asked in various ways, thousands and thousands of times over the years, thousands of times. And I say this without exaggeration. I don't think there's not been a single time when someone has said consistency. Literally, this is not hyperbolic. 0 out of every time I've asked that question, no one has said consistency. And so it's interesting because I've reflected and sort of looked at the successes of various people and looked at what makes people successful. I think consistency underlies everything. And so if you think about Warren Buffett as an example, he would say that one of his great competitive practices is reading hundreds of pages a day. Like that's what he does. And so many people can read. Many people can read hundreds of pages. Maybe some people can even read hundreds of pages a day. But Warren Buffett applies that practice every day. He's very consistent in reading hundreds of pages a day. That turns a strength, when applied consistently, into a massive competitive advantage. So that's where consistency is an enabler. Tom Brady recently had his number retired in Foxborough, which is a short drive from here. And when he had to summarize his success in his Hall of Fame or retirement speech, he said, "You don't have to be super special to be great. You just have to be consistent." And he was particularly consistent in how he ate. He was consistent in how he took care of his body, and it's well known, especially in these parts, how fanatical he was about that. But again, if you're going to eat well and eat healthy and take care of your body, if you do that consistently, that leads to a compounding set of results. If you do that sporadically, that's a whole different ball game, and so your results compound with consistency. What are other examples? Oftentimes, when I sort of help to onboard a new employee here at Volition, I tell them, do this practice. If you don't understand something, write it down and ask someone later. That's a very simple practice that everyone can do. And I suggest to people, keep doing it every single time, write down the question, get it answered. But eventually people stop. And what happens is if someone consistently does that, every time they don't understand something, they ask, they go find the answer, they do that every single day. You do that over a long period of time, the value of that compounds versus someone who does it sporadically and then stops. And so, again, I sort of view consistency as this unlock that somehow and that's why I call it the preeminent superpower, which is it unlocks every other strength because there's few strengths.
You'll see that when he talks about consistency, he mentions examples like eating well, reading lots, writing down questions when you don't understand something. These are all simple things, so the key to consistency is simplicity, as Rocky and I see.
Number one strength or superpower. All right, so that's the second one that I wanted to talk about. And by the way, I'll take questions on these at the end. It's I don't want this to be a one-way conversation. So this third one and the last one we'll talk about today, Yes, I remember this. So I wrote this, about 4 months ago. So 2 buckets: 1, inefficient spend today; 2, transformative opportunities tomorrow. Take capital out of the first and move it into the second. Cutting spending today isn't about not investing in growth. It's about building a capital base to invest in better opportunities tomorrow. So the context of this post is really an observation that I've seen over many, many companies, many of them. What's happened is a lot of companies have been built in an environment where capital was free. That's, call it the 2015 to 2020, 21 timeframe. Interest rates were 0. Capital was free in our world, largely free. And companies were raising tons of capital. And what was happening as a byproduct of that capital raise is people were spending it quite aggressively, and they weren't doing it in a disciplined fashion. And then what happened? Interest rates rose, stock market corrected, capital is much more expensive in our world today. What that has forced is discipline. And so now you only spend capital on things that you have a definable ROI, you think can be accretive to your business. And that discipline has been very, very healthy. And what's happening with some companies is that the lack of capital has created a discipline which has found the seam in these businesses where you should actually spend capital. This is the accretive seam. This is where this can have a high ROI. But what you don't have now is you don't have capital. So you've come from an environment where you're like throwing capital away at things that don't generate great returns. The absence of capital has forced a discipline which shows you your seam, but you don't have access to capital. So what do? You try and get profitable and you cut expenditures. And the cutting of expenses in the context of a company can sometimes seem like you are giving up on growth. But that's not really the mentality to think of it with. Cutting expenses is really the installment of banking capital to pursue more transformative opportunities in the future. If you can't get capital externally, you have to get it internally. And you do that by running a more efficient business. So sometimes when you start rationalizing expenses inside of a company, what the culture and the way people receive that is you're waving the white flag on growth. And that shouldn't really be the way you think about it. The way you should think about it, it is the first step towards creating capital to grow in the future. That process may take time, but it's a necessary step. And so I do think a separate thought on all of this is the best way to behave when you do have capital. The best way to behave is like you don't have capital. That is the best way to behave. So great CEOs will sort of institute a culture of a lack of capital, even if you have it. This applies corporately. This also applies at the household and personal level. The smartest people, when they accumulate capital, will still act like they are preserving it and still executing on expenses and investments with a great discipline. So that's where this post came from, and I hope that is helpful. All right, so those are the 3 posts that I had to cover today. I'll take this off my screen. Let me see if there are any questions that I can answer. I do see some comments as they fly, so I'll give it. There's a lot of questions. As I mentioned before, what is my superpower? You're asking me, so who's that? That's Sherlock asking me what my superpower is. Sherlock, that's a very leading question, because I actually think consistency, the very few things that I think I've been good at that have helped impact me personally and professionally, I've also applied consistently. So I think that should be my superpower, probably. Is this live right now? Yes, it is. All right, that's another question. Let's see, what else do we have going on here? Wow, these are flying. I can't even keep track. What type of rate environment do you prefer working in? This is from Richard. Is this Richard? Okay, so that's a great question. So I think the person is asking, do I prefer to work in an interest rate environment that's like 5-6% or even higher as it is today, or 0% when money is free? To be honest, I prefer today. I 100% prefer today. I think the zero interest rate environment sort of incentivizes people to behave irresponsibly. because money is free and there's always another capital source down the road. And that's just not an environment that I know I'm comfortable with. And so in that kind of environment, I'm probably somewhat conservative. In this type of environment, you know the rules. You have to grow profitably. You have to be capital efficient. That's how the world works. And it's not hard to convince the entrepreneurs and founders that I work with that that's the case. And so that is the dynamic where I'd prefer to work in this environment. And I think from a Volition perspective, this is our power alley as well. What's a new growing industry that piques your interest? We've done a lot in creator economy, the whole ecosystem. We invested in a company called Mosaic, which does split payments for creators. So this could be anything from singers to video creators on YouTube, to Twitch streamers, to Etsy store owners. They do infrastructure for payments. We've invested in some creator-led brands. We have a company called Doing Things, which is aggregating different social creators and content creators. So I love everything around the creator ecosystem. A separate point is one of the great assets of a business is just having tailwinds of secular growth in the market, and that's what's happening in the creator world. All right, let's see. What else do we have? All right. How did you start Volition Capital? Okay, Parthik is asking that question. We started Volition Capital in 2010, and a few of my partners, Roger Hurwitz, Sean Campbell, and myself, we co-founded the firm and to be a pure play growth equity firm. And it's been a great ride ever since. Is raising capital smart these days? Solomon Singer, thank you for the question. Is it smart to raise capital? I think it's smart to raise capital when you can use it accretively. If you can't use capital accretively, then don't raise capital. It's pretty much as simple as that. That's for growth capital. You could raise capital to do secondary, which is to provide shareholder liquidity for shareholders or yourself. That's another separate reason. But I think those are probably the two relevant reasons. I wouldn't raise capital just because everyone else is doing it. I wouldn't raise capital because you have to compete with other companies that are raising capital. I would get at the basic principles and focus on high ROI use cases. And if you think your capital can be accretive, you should do it. All right, what else do we have here? Do you think SPACs are profitable? Interesting. I mean, the SPAC market has been very challenged. I'm not sure I'm going to answer your question as directly. We invested in a company that was sort of a SPAC and growth collaborative. And so that was a means for companies to go public in a sort of an alternative way in the 2020 timetable. I think a lot of those companies have had challenges in the public markets, but many of those companies probably shouldn't have gone public. If I'm being candid, they should have probably driven towards greater efficiency as private companies, but they are now public. And what you're seeing is a lot of them have faced some challenges, and some of them will not survive those challenges, and some of them will. And they will be ongoing, strong, profitable, growing businesses. And we'll look back at this time as perhaps a time that they were quite undervalued, and some won't make it. And we'll think that going public via SPAC probably wasn't the right decision. So we'll see. That's a bit of a binary dynamic in some of the SPACs that we saw in the previous few years. All right, what else do we have? What's the one investment you passed on because you undervalued it? That's from Captain Butters. Let's see. Oh, gosh. Oh, yeah. Okay. This is a great one. This was when I was younger, to be fair. I was an associate at Battery Ventures. It's known in the Boston community. It might not be known as broadly, but if you Google it around, you'll find it. I was the first investor to actually meet with Mark Zuckerberg and Eduardo Saverin when it was called the Facebook. I won't go into what we valued the company at, but it was not what Mark and Eduardo wanted at that time. And at that time, which is a different era, the idea of investing behind a sophomore in college for a social network was like no one did that. Funny story, I'll just tell you. funny story. I did have Mark and Eduardo come to my office in Wellesley Hills in Massachusetts, where I was at, and I forgot at that time because I didn't talk to a lot of college students. I forgot that they didn't really have a means of transportation to get to our office, so they took a cab to meet with me, and I felt badly that they paid like $60 or $70 for a cab from Cambridge to Wellesley. And so I drove them back myself, dropped them off at Johnston Gate and Harvard Yard. I gave them the $60 or $70 in cash to pay for their cab. And I suppose if I put that $60 or $70 into the company at that time, it would have been worth a lot more, but such is life. So that's probably one that I wish I would have back. But what you learn in this business is if you don't pass on great companies somewhere in your history, then you're not seeing great companies. And so that's all part of the journey. That's what makes it fun. Pineapple on your pizza, yay or nay from Liam. Hawaiian pizza, I like it, but I'm more of a pepperoni guy. Thanks for the easy softball question. I appreciate it. All right, let me take a couple more, and then we will call it a day. Lots of comments. Favorite pizza place in Boston. Oh, thank you. The pizza is the theme of the day. This is a very easy question. Pinocchio's Pizza in Harvard Square. So that would be my favorite. Someone's asking, what is my favorite book of the Bible? That would be Romans. It's the most theological one, and that's sort of right up my alley. Some of you may see that I try and capture in my sermon notes every Sunday. All right, what's the best advice you could give to try and shift career industries past your early 20s? Ooh, I'm not great at career advice. I'm great at entrepreneurial advice, perhaps, maybe. I generally think good things start where you identify a problem that's not being solved. And so whether it's your career or a startup or something along those lines, look around you, see if there's a problem that is unsolved that you're passionate about solving. Maybe you should look for companies that are trying to solve those problems and join them and sort of align with them on your passion for solving that problem. Maybe that's a good way to make a career change. All right, one last question, and we'll call it a day. Okay. Favorite sauce, favorite books. What is my favorite book? To be honest, I don't read that many books. The Bible is my favorite book. Favorite ice cream flavor. Okay, that's the easiest one. I'm a vanilla guy. I'm sorry, that's so boring, I know. So I'm a vanilla guy, and do I like dogs or cats? Maybe I shouldn't say this, I'm more of a dog guy. On that note, I'll end it. Thanks so much for joining, I appreciate it, and maybe we'll do this again next time if you guys enjoyed it. Thanks so much, take care.
Good show, Larry. Positive little show there from Larry. He prefers dogs to cats. Typically, if somebody asks you if you prefer dogs to cats and the answer should be cats, then you could always say you like them equally. What are everybody else's thoughts about that? I'm just going to answer the door and get back to you. Not really. Just want to say about pizza. They see you there. Last thing. You can still play though. Here. Okay. Don't be sorry. So I liked Larry's chat there. It would have been good if he'd answered some of our questions instead of dogs and cats or ice cream and pizzas and pepperoni and pineapple and that sort of bollocks. But it was interesting hearing him talk about how he turned down Facebook for an investment. And then his approach being, if you're not missing good companies, then you're not seeing good companies. So that's positive. What else did we think were good questions that he answered well? He talked about growth and the rate of growth, and he spoke about, in his questions it was, and his answers it was, the growth of growth. And what he's speaking to there is the rate of change and the acceleration of that growth, as opposed to, you know, some weird meta growth of growth thing. So it was interesting hearing that. That's a duck with a hat on if I ever saw one. What did you guys think? Any other feedback in the chat there about Larry's little interview? I like the way he took on the different tweets. Whoa. I've got some more chips. Carthage must be destroyed. This is Larry Cheng. He's a board member at GameStop. He was doing a live stream. Because he doesn't do live streams often, he got a lot of attention.
Ah. Okay. And that's who you're chatting to right now? Or lots of people?
No, I'm not chatting to him. I'm chatting to these people in this box here, and I'm streaming his stream on my stream.
Ah, okay.
In that horrible meta way. That's him ending on a smile, which is positive, and it's good to see that when you end a Twitter live stream, it captures your last screenshot, so I know when I hit the end button, should I ever do that to make sure I'm smiling. He talked about investing in deep value tech. Mario, can you look at Bitcoin? I can look at Bitcoin. Bitcoin is just losing that $60,000. Going through an important fib. If we take this guy down to the actual low, where is the actual low? It's over here. Well, that was a speculative low. Then it needs to get back above the 236.61.8. If it does manage to do that, it'll be coming back into this downward sloping channel, which is not real because it's only had a couple of touches. It's probably more accurate to describe it as a wedge. And as you can see, it broke out at 75% of the way towards the apex. The full move is 538 bars. What's 75% of 538? 430. 430 bars. Which is about where it broke down, right? 430 bars. That's about 75% of the way to the apex. And as it comes to the apex, that's where the two lines meet. More and more market participants are aware of the fact that either the support or the resistance line are going to break, and so everybody makes up their mind to either get the hell out of a trade if it looks bearish or get into it if it looks bullish. So it's mostly longs leaving rather than shorts deciding this is a thing to jump onto. In terms of breaking out of this type of formation and moving to the downside, you're already below all the previous lows, so you don't have a fake out zone to look for price to go to and bounce back from. Instead, you're looking at long-term support and resistance, so maybe the lowest you would find that on a 4-hour time frame. Looking left, you can see these 60,000, 59,000 and change is important. This previous low is 56. You know, 4 grand off something that costs 60 grand. What percentage is that? 8%. 8%. That's a significant move in a short period of time. And at this point you would be looking at prices coming down and testing that important level. Should they get here and break below it, then you would go back to all of this price action, and this would be described as Wyckoff distribution. You might also look at it as a double top, and you would measure that back to the ascent that took price up here. So in that instance you would be looking at these moves, and you'd suggest that it could potentially break down this equivalent sort of style. So that was the high at this green line, and you'd be talking about a move all the way down to 40,000 and change. If you're at 40,000 and change, go up to the daily time frame and point out that that matches up with this trend line, long-term trend line underneath price action. A few touches here, a few touches there, makes it real, and then you'd be talking about testing back down maybe between 42 and 39,000, and that would be a huge break if we were looking at Wyckoff distribution here, but it's too soon to make that call. because you've already done the measured move from inside the wedge, and it's not broken through previous lows. So if this is the wedge measured from the first touch at the bottom to the top side here, take that on, gone just beyond that level, zoom in a little bit, you can see that it's mostly wicks below this guy, and so price action closing back towards that level isn't completely unexpected. The same liquidity from within the prior formation is how you do the measured rule from when price breaks out of it. And so if it is that price recovers here and it's got bullish divergence throughout the downside move, then it could be making its way back up again. Important target 61.6, 61.7. Then you'd be testing this prior part of the formation where price broke down and back inside that wedge again. So Bitcoin's recovery would be measured with perhaps this fib, 236, back above 59.4, already managed that, and then the 50% of the move, you know, a strong test would at least get 50% of the way, so you'd be looking for it to get there at 60,600. Having broken 60,000 as a psychological level, you could imagine that price would want to test it again, maybe a couple of times, maybe hold that 236 should it get there and come back, and then look to find resistance or support should it push back above 60,000. What would it be in such a strong psychological level and a strong round number? This is my brother John. He's the other brother.
Hello there.
Hello there. He's the other brother. He's born in Ireland on St. Patrick's Day, like Rocky's born in Scotland on St. Andrew's Day.
And Jamie, you were born on,
I was born on 11th of September.
which was also famous for something else before 9/11.
It was William Wallace beat the English up regularly on the 11th of September. But we forgive them for all that. And for chopping him in half and sending him all around the country. Or quarters. So that's interesting. Lipson. This is live person. It's a conversational AI. And today somebody came in. Somebody, I don't know who, but somebody came in and they went in heavy on the options chain. They bought up shitloads of contracts. They did market orders, intermarket. They did huge buys, taking top level interest in that company, massively impacting the option chain, buying up everything that was going, and they did it all in at around 58 cents, currently at 57.99. Huge interest coming into Lipson with some seriously massive accounts buying into that. So that's interesting considering the hit that AI had generally today. Nvidia also down 6.63%. And when Nvidia moves down, Bitcoin moves down, and the whole AI market's taking a bit of a knock, which we can see here on the AI fund. You know, you had SMCI also down 8.65%, and a lot of red across the board. I'm not sure if you're able to see that because the chat box is probably in front of it, but that's interesting information there to see that somebody coming in heavy on Lipson when the overall sector isn't doing particularly well. And SPY, or SPX, the equivalent there, closing at 5447. Testing that important horizontal, it being a golden pocket, having gone through a 236 at 5483, then 54747. That sort of area would be a natural area for price to find a little bit of support. It's also wick lows and the previous high from formation at this period of consolidation. And it may well be then that SPY looks to find support here and move up in line with this fib channel that's been a good guide on price since the recovery at the end of May, and overall a really good area to look to on SPY since the gap close and the retracement after the reaction to the previous recession. So this retracement here being about 50% of this low to high. Here's that 50% level, that's that retracement, really very much on that, was what we predicted, you know, since 1826 or something. Every retracement post bullish breakout after a recession has led to no more than a 50% retracement, and then capturing that fib channel, rise to the top side and getting higher highs has led to this current action on price. There is a gap, it would be filled at 5373. That's a huge percentage move from here So I wouldn't expect it to all happen in one go at 1.37%. And typically this thing doesn't move more than a few fractions of a percent in a day, and not much more in a week. VIX itself still at 1337, and we're speaking about how if this is to be a complete breakdown in SPRI, you'd be looking at this thing coming back and testing $16. That's with this high previously back inside of a downward sloping channel, and it may well be that if that is the case, SPY is moving down and getting to those 533C levels. So you'll be looking at VIX up at around 18. And if you're looking for a really good trade, it's either futures, which would be highly leveraged on SPY, and you could manage that trade. And if you want to talk more about how to do that, get in touch on the Discord. Otherwise, you might be looking to take a lower risk product without inherent leverage and looking at a potential 37% move on VIX. If it doesn't make that, it could certainly come up and test this, gain the 50% level, and that'd be a test of strength. And from here, that's 19 to 20%. Healthy move there, easy to manage risk within those parameters. And a little bit of a take on SPY, Bitcoin, VIX, and Lipson. So that's those questions answered. Good evening, ladies and gentlemen. KST.
What's Rocky's birthday? It's all
Rocky's
about. Oh,
birthday.
Richard.
Yeah, Rocky 30th. TradeSpot. I finally used the KST indicator today along with the RSI and DMI for a day trade, and it went really well, thank you. Whoa, what am I clicking there? Great to see, Tennessee Texan. Thank you very much for that comment. Great to see you're doing well with those trades. Excellent news. Values for me are virtues. Hello, there's a hello John from the Critical Meowler.
Bonjour tout le monde. Especially vis-a-vis.
Vis-a-vis, that's Lisa. She's the moderator and does the chapters. She's really handy in the community. Top viewer, top part of the community, Lisa. But she calls herself Vis-a-vis here in the chat box. And then Marcus, he's from Sweden. Hi, John.
Hello, Marcus.
Lots of other folks here. So,
do you know, I'm like the most uneducated when it comes to all of this.
we can't hear you.
Oh, really?
Yeah, there's what lively.
All right. So I'm the most uneducated when it comes to all of this. It kind of sounds like Jamie might be like a really good airline pilot, because what he's saying sounds like what pilots might be saying as they're coming into land.
I can't fly planes.
No, but I'm a regulated financial advisor. I do mortgages in the UK, so I know lots about mortgages, investments, but not sort of trading side of things. So mortgages, protection, investments, that side of things. So I find this whole thing fascinating, but also way over my head. So please don't expect me to be coming out with any gems of inspiration.
That's okay. We've got resident experts, and now we have resident experts in mortgages. A lot of people will be asking themselves questions like, well, rates are bloody high, and there's this concept at the minute that the Federal Reserve in America want to bring rates down because then it makes money easier to borrow, which makes more liquidity in the system, which means that there's a increase in capital velocity, and that leads to capital accumulation, speaking on a macro scale. One of the problems if rates being so high and inflation being so sticky is that key factors keep holding it up, and one of them is energy. It's difficult to control that because the Federal Reserve don't have a direct impact on the prices of energy. It's mostly the State Department and who America decide to go to war with next, and how much oil they have. And if any of these companies that or countries that produce it start selling it outside of the petrodollar deal, then that gives America the right, or at least the incentive, to go in and start impacting that market. So energy is a difficult one to fix, especially for the head of the Federal Reserve, who himself isn't involved in that side of government, and totally serious there. And then on the other side of things, the other part of inflation which is sticky is housing, and that's because people don't move house all that often. So when they do move,
Average 7 times in their lifetime.
is that in Britain?
Yeah, in Britain, 7 times.
How many times do you guys move house in America? I think it might be slightly higher. You are more open to the idea of moving house, and you're better at capitalizing on capital appreciation from your own houses over there in America. Whereas here in Britain, JCC CBD, that's our dad in the chat box.
Hello, Dad.
Great to see you, Dad. Good to see you, Dad. So in this instance, maybe you're thinking about how you move to a new house. It means that you have to start paying higher rates on your mortgage. If you rent out a house now, you're having to pay rates to the landlord, which will obviously mean that he's making more money from his house than he would if he had the money in the bank. So you're going to have to pay rent that's commensurate with the interest rate at the bank. And also, a lot of mortgages are given to homeowners, but far more. But maybe not actually, not here certainly. A lot of mortgages then are also given to landlords who rent that place out, and so they've got a cost of capital which they have to cover by renting the flat out or the apartment or the house or the farm, whatever it might be.
It's about 60-40. 60% residential owned, homeowner owned, to about 40% investment mortgages.
60-40, right? So 40% of people are much smarter than those 60% of people. And that's this problem with inflation then, is that it's difficult to bring down rates because house prices are so expensive, rents are so expensive, and in America they've got this factor they've considered was how much money could you make if you were renting your house out but you live in it, and it's the homeowner rent factor. So there's these considerations, and in terms of like analysis and looking at the charts, we use it to determine where the main indexes might be going, but what really impacts people is the worry they have when they have to move into a new home now. If their rent goes up and they have to find a new place, or if they have to get a new mortgage because their current situation is changed. And how do you handle that then when somebody, as a mortgage broker, if somebody phones you up and says, I'm really, really worried, I think I'm going to lose, my house I'm in at the minute, I have to get a new one. The only thing that I can get from the bank is a mortgage that's on the equivalent term means I'm having to pay 3 or 4 times as much. I can't afford that, and I feed my kids. How do you handle that?
Well, that's actually a really common question. And you're right. Of course, with most residential homeowners in the UK anyway, and in Ireland, they have a capital and interest repayment mortgage. So their payment each month is, of course, the interest that due on the loan, but also an element of capital. And whenever you find that interest rates have gone up from, I'd say an average mortgage rate 2 years ago would have been about 1.89 sort of percent, up to about 5.59 now. So it really, really scary. But of course, when you're a capital and interest repayment mortgage, a large part of your payment is attributed towards capital. So what you've found is that the interest rate may have tripled, but your mortgage rate hasn't tripled. So as a homeowner, yes, it's really hard. And especially in times like this, whenever other expenditure on things like utilities, like food, the cost of living crisis is driving everything else up, it can be a real strain and really put people in a difficult position. Now, before I come on to that, though, of course, with investment people, for people who have bought it as an investment property, 9 times out of 10, those won't be capital and interest repayment mortgages. They'll be interest only. And so whenever you're tripling the interest rate on an interest only mortgage, effectively you're tripling the mortgage payment each month as well. So what can they do about that? Well, the only thing the landlord can do about that is that they just have to end up putting the rents up. And then it becomes this cycle for tenants where they're finding that their rents are going up. The landlord's insurances and service charges and ground rents are all going up, and so there's so much pressure on these tenants. And there's apart from actually jumping into the game yourself and starting to take a risk and starting to borrow money yourself on property, there's very little that you can do apart from going maybe to a less salubrious area. But the people who are actually buying houses who live in them, there's so much that they can do and they don't realise that they can do. For example, at the minute in the UK, there's a massive big thing in the newspapers and the media, and politicians are talking about it all the time. And they're talking about how where the average sort of mortgage term, total mortgage term, used to be 25 years, but now it's jumped up to like 35 years. And you got people like, how old are you now, Jamie?
40.
Right, so you're 40. So you got people now who are 40, because the average age of taking a mortgage in the UK now, though the average age of the first time buyer in the UK now has jumped right up to, I think it's 33 or 35.
Rockin' hell.
So you can take a mortgage term up to 40 years. So you've got people who are, 35, 40.
When are they having kids if they don't have a house?
Well, you can have kids without us.
You're allowed to have kids without owning a house.
Apparently, it's
you
not
ban
a rule.
that.
Apparently, it's not a rule. But then the big thing at the minute is that you've got people like taking 35, 40-year mortgage terms. And they're saying, the newspaper likes to say, oh, they're not even going to have paid their mortgage off until they're 75. They're going to be working until they're 75. But let's get real here. Nobody buys a house at age 35 or 40 and stays there for 35 years. No. You buy a house at age 35 that suits you for you, your partner, and your future family or the child you've got. But at some point, you're going to sell that. As we say, average is 7 moves in your lifetime. So you're going to downsize at some point. So the different things we do as brokers is we stretch the term and if I lend you £10 over 10 days, that's £1 a day. If I lend it to you over 5 days, that's £2 a day, right? So stretching the term brings your mortgage payments down. But also brokers have got exclusive deals with lenders as well. So we get, I've got 107 different lenders that I use. If I asked you to name 107 different lenders, you just probably
Mom, Dad,
near that.
Brett, Rocky. Yeah, 107 different companies offering hundreds or if not hundreds of thousands or millions of pounds, some of them, to people to buy property. That's a big amount of companies servicing that, but they all have the same capital requirements and they all pay the same cost of money themselves. So what are the differences between these 107 other than the interest rate?
Well, around criteria. So you might find that, for example, a lot of with the way the economy's been, a lot of people have gone self-employed. Mm-hmm. And they think, well, it's much more difficult to get a mortgage when you're self-employed.
Right.
And that's not true.
No.
Because there's lenders out there who'll do a mortgage for you with just 12 months worth of self-employed history. So either a tax return or accounts. But you just don't know who they are.
Yeah.
And so general public thinks, I can't get a mortgage.
How does the general public get a mortgage? How do you generally, the people think you go into a bank, right?
Well, how many people do you think actually go to a bank and get a mortgage
everyone, no?
Okay. So, so the last 5 years or so, it's been above 70% of people actually go to mortgage brokers.
Oh, right. So they're smart.
This year it's predicted to be over 90%.
Wow.
So we're dead busy. And normally, nearly every case is somebody saying, I have this situation, I think that's impossible.
Uh-huh.
And what we can do is we can do things like, all the different lenders have got different criteria. So it might well be that for a short period of time, like for the next couple of years whilst interest rates are higher, you might want to switch from a capital and interest repayment mortgage, let's say your payments are £1,000 a month, down to being interest only, where it might only be 300 quid a month. Now, most of those 107 lenders won't let you achieve that goal unless you meet their really strict criteria. Like the high street lenders, they might say that if it's a couple, your income needs to be 100 grand a year. But whenever you've got a broker working for you, they know that they've got lenders out there who say, well, if you've got 100 grand's worth of equity in your property, it doesn't matter about your income. We'll let you switch on to an interest-only mortgage.
Okay, so it's about that loan-to-value rate I have heard about, right?
Loan-to-value is important, but more important than that is the equity that you've got in the property or your income. So a lot of people out there have good incomes, but not much equity, or a lot of equity, but low income. And so as a broker, you just do a full fact find on the customer, and then you try and marry up their circumstances to the lender's criteria. Uh-huh. And it could be any one of those 107. I mean, I do a lot of mortgages with companies that British people in here won't have even heard of.
Uh-huh. Well, that's super interesting. Has anybody got any questions about mortgages or
Probably
the process not. Or how you might? I imagine that they would, at some stage in your life, you're going to probably want to have a mortgage. It's a good idea to have a mortgage, right? It's no point spending all your money on a house if a bank's going to lend it to you and your disposable income would meet those payments, is there? I mean, if money's
Well, look,
available
you
there-
guys here all know about investments, right? You're into crypto, right?
Mhm.
Well, anybody who's really sensible will have a varied pot of different investments,
Mhm.
and having a mortgage or having property is just one of that portfolio that you
Yeah.
should consider. Just as it is having some money in an easy cash account, it's
Yeah.
all different. So it's having the right balance between it all, and not all having all your eggs in one basket.
Right, that sounds like a difficult equation then, the right balance. It's different for everybody.
It is different for everybody, but I have a general rule that I
Uh-huh.
tell everybody.
All right.
Is have 3 to 6 months worth of cash in an easy, accessible account. That's your number one point. And then everything else expands from there. Oh, and take advantage of all the tax advantages of pensions as well, if you can.
Let's start a poll then in the chat box. Do you have 3 to 6 months worth of costs?
Well, no, of take-home salary as easy, accessible cash. Yeah, in cash. Yeah.
So that's a good question, because a lot of people live in hand to mouth, right? Even people that are getting paid 10, 20, 30, $40,000 a month, their expenses are so high that they don't have anything on hand, right? And so there's this, miss one mortgage payment, you could go from a high income job, an expensive lifestyle, to being like out on the side of the road, and that it makes it you can't get to your job. You can't, you're living in a van. You're trying to make it work with what's coming in, and you're always trying to catch up. Especially in America, where there's a heavy focus on debt, credit card debt, and all this type of making your salary stretch that little bit further by borrowing, rather than using borrowing and then paying it off by the end of the month. So is that something that you're seeing more and more in Britain with the rise in cost of living, that it means that more people are failing that test?
Absolutely, and it's such a shame because not a lot of people reach out there and look for advice. Whereas I'm a mortgage and protection broker, but I'm a fully qualified financial advisor. But I only focus on mortgages and protection, but I must know 200 different IFAs and brokers throughout the UK, and I don't know one single person that won't give free consultancy.
Mm-hmm.
And I don't know what it is that pulls some people back, that they don't feel confident to go out there and explore things. I mean, like, I have clients that come to me and have 6 different conversations, and I spend 12 hours doing work for them, and I don't hear from them. They don't do anything.
Fuckers.
Well, you think that, but then 3 years later, I get a phone call or a text message saying, thank you so much for telling me about building my savings so that I'm not going to find myself, thrown out because I've lost my job and I don't have any savings. And then what I've done is I've done this regarding building up a deposit, but at the same time, I've made sure that I speak to my employer and I decide that I put some more money away before tax on my pension, and they come back to me in a really strong position. And then now I'm ready to go. So I think that it's about, from any decent broker or financial advisor's perspective, you should always offer a free consultation, which is no pressure at all. It's just, tell me your situation. And I like to say, what I need to do is I need to know you. I need to know your finances, like, intimately. I need to know everything about your situation. I need to see your credit report. I need to know all about your expenditure and all that stuff that you don't like to maybe tell your partner. And I go through all of that with them, and then I just set them on the right path. And whether it's the next day or it's 10 years time that they come back to me, I just, like, when I was 18, I got my first place, and I got a mortgage. I was at uni, and I lived in the kitchen on a futon, and I rented the 2 bedrooms out. But, like, my dad, who's watching, he'll say that he'll agree that, it did pay for most of my uni. My parents had to help me, but not as much as they would have done. But you just take these sort of gambles in life, don't you? And when I did that, it really gave me a passion for mortgages. It showed me what it could do for me and gave me that freedom.
Interesting you call it a gamble, right? John calls it a gamble there, buying a house and then not enjoying that house for yourself, but instead renting it out and living in the kitchen. So, sometimes a gamble is more a sacrifice that you're making for the long term, and that's That's a good type of gamble. I'm also with some familiarity with giving people advice with regards to their finances for 12 hours or more, and then they disappear for 3 years because GameStop's in a downtrend, and then they show up in the chat box this evening. So shout out to you guys. And that's that interesting point though you make about how they come back and they've decided to like take your advice on board and change the way they live their life so that they can in their future self is able to benefit from their sacrifices now the same way you did, you know, because we're all in a commune with our future self. And you know, without putting like complicated philosophy on it, you want to be like your own best friend, and your own best friend in future will hope that you already did all the hard work so that they can relax and put their feet up, right?
Yeah.
And that makes me think about the point you went to earlier when you said that we all downsize. And do you not feel like that's a little bit tragic though, that we all like this idea of a big house and so on, but then we downsize? Or is it more that the reason you had a big house was because, you know, your kids weren't at university yet, you needed that space for them, and really it isn't ideally what you want to live in anyway? You'd prefer like a nice house in Edinburgh compared to something in London, or, you know.
Hey, you're speaking to a guy who's got 2 teenage girls, right? I'm a 50% childcare dad, and I have been for 8 years. And when they're with me, my 4-bedroom detached house is, you know, it feels good, it feels buzzing, it's lovely. But then 50% of the time when they're not there, I feel like I'm going mad in this massive house, knocking up, you know, nobody there to keep you company. You think, shall I even put my heating on? What's the point in heating like 11 different rooms or whatever it is, whenever it's just me moving from my bedroom to the lounge to the kitchen to the bathroom? So no, I don't think so. I think like whenever, like with any sort of investment, it's not forever. And whenever you're thinking about making a trade to buy something on crypto, you're also subconsciously thinking, when am I going to sell it? And I think it's the same with properties or anything else. When you're putting money into your pension, you're not actually thinking too much about the money you're putting into your pension. You're thinking about what you're going to get when it's at the end.
Or else you're going to fuck your life up, right? You can't constantly be trying to go for things that you don't need, that aren't suitable, just because you think it's cool or you wanted that particular type of house at that particular time. If it's not suitable, you have to have the courage to sell and move.
Yeah.
And it's the same with cryptocurrency, or, for example, there's a big community here trading GameStop, and some of the investing narrative that's spoken about online is we're not selling, we don't have an exit strategy, so that we as an investor base seem irrational, so that our strategy can't be countered by people who would otherwise short it or look for areas above to short it. You know, if they know that all the apes are going to sell at 220, then of course they're all going to force price down, not try and let it get to that area, never let it get higher, and it creates this self-fulfilling prophecy. But that narrative online has seeped into people's actual behaviors and answers, and they actually now have adopted this culture of never selling, which is so very, very costly.
Yes.
So I try to talk to people about how any good investment, when you buy it in the first instance, has to have some plan for later selling.
Yes.
Right? Because you can't manage that risk of buying the thing into the future indefinitely.
Yes.
And so there has to be some way of managing that thing. Also, your capital's invested, and there's a opportunity cost, you know.
Yes.
And you know what it's like when you buy a house. You're not buying then the Lamborghini, you're not buying the place in Monaco, you're not spending it on your 8 different girlfriends.
Yeah.
You're not buying jewelry.
7, I've only got
7 girlfriends. That's a lucky number. So there has to be some concept of how you're going to manage the position. And if that means that you're not going to sell it, then if a house, it means that perhaps you want to rent it out, you want to put it buy to let, you want to get other clients in there. Is that something that commonly happens? People buy a house and then they go from normal mortgage to a buy to let mortgage.
Oh, it's amazing, man. I mean, like I've got so many landlord clients now who didn't know they were going to be landlord clients. Wow. So they come to me and they say things like, I can't sell my house. The market's depressed at the moment, which it is in the UK. I'm guessing it is pretty much across the Western world or the global north. And
America's doing a lot better than here, but yeah, it is a bit bad.
Okay, so here things are really sticky. So you're seeing lots of house prices taking a little bit of a dip. London especially, although I think it's starting to pick up a bit. But like I'll have clients come to me and say, I'm in this house, it's not selling, but I need to move location. I need to go somewhere else. I can't do anything yet. I can't get that new mortgage yet. And then I'll say to them, okay, well, I'm sure you've heard of buy to let. And they say, yeah, of course, but I don't need a buy to let mortgage. I want to move into this new house I'm buying. And I say, okay, well, let's flip it on its head. How have you heard of let to buy?
No.
So let to buy is the sort of of reverse. So what we say is you can't sell your house, so let's let it to buy something else. So we'll switch your current mortgage deal with your current lender on your current property onto a buy to let mortgage essentially, but it's called a let to buy mortgage. And at the same time, we'll release a whole load of equity from your property, and then we'll use that equity as the deposit for the house you want to buy. We'll raise you a normal residential mortgage on the place you're buying. In the meantime, you've kept your existing property without having to knock it down by 20% just to get rid of it. And you've got rental income coming in from it, which is an additional source of income. And you now have a new investment stream, which is investment buy-to-lets.
Fucking brilliant. That's an amazing solution. That's huge for people who've got no idea about mortgages. That's a massive, massive benefit to understanding that strategy. Yeah. And when it comes to people selling or not selling their GameStop position, there's also like option contracts. You know, you can take out insurance on the idea that the price will go down in future by selling a covered call. That means that you get like the premium for selling the contract, and it'll only be triggered if price does go on up to higher levels, which you'd be eventually happy taking it at.
Yeah.
But if that doesn't happen, you've collected the premium and you've still got the shares. So it's like the let to buy, you know, you're getting the income.
Yeah, wait for the better day to arrive rather than panicking and jumping out.
Yeah, panicking costs so much money. And so if you're having to sell a house in a depressed market, you're having to then take a hit off the top of the home value just to get it shifted.
Exactly.
Because somebody else knows you're in a distressed position.
Exactly. Yeah. So why allow that to happen? Instead, become what's kind of being classed as an accidental landlord.
Yeah. These guys, a lot of them are accidental accidental massive shareholders. They never expected to have such huge positions. Some people sell their car and stick it in GameStop. The thing goes up by 20%, and then they don't want to sell those shares because that price move makes them convinced it's going to go up more. But they can take insurance over the idea that it doesn't.
Okay. By
getting an income by selling an option contract.
Okay.
And then these sort of avenues are open to people. So if you've got like this open mind about your investment, that you understand that it's not something you're married to, it's just one of a collection of things you're doing.
Yeah.
Then you don't get too attached to it that you make irrational decisions, and you can take advantage of that flexibility. But I mean, it seems to me that's the sort of thing that when someone's panicking and stressed, they're not going to be able to put this creative solution to use. That's why it's so important they have a mortgage broker.
Exactly. That's absolutely. You need somebody who can empathize with you, who's professional to understand the whole market and speaks to hundreds of other brokers daily and reads all the media around it and has a really good feeling for how things are going to move. But then who can also be objective about it and can take a step back and can say, well, I have all these experiences with different people and these are how they solve the problem.
Well, we end that poll in the chat box. Do you have 3 to 6 months salary in cash? And 56% of people no, 43% of people yes.
So on that basis, I would say that people on here generally are risk takers, risk lovers, we call it in financial advice, which is great because every investment, whether it's a property or crypto, is a bit of a gamble. But this is that's reflected in the fact that you're talking about crypto, and 56% of people don't have that what's called an emergency cash fund.
Yeah, you need your emergency cash fund. What if Gary Gensler shows up at the door tomorrow and starts asking you for your GameStop fund? He says he'll be back at this time. You'll be back at this time tomorrow with a lot of money. What are you going to do? You're going to have some sort of get out of jail card. You're going to have a go bag. What if, Gus Fring turns up and he's asking for his cash back? You're going to need to get out the door and make sure you're never found again. Right, so that's really good tips there from John. And John, you've got a mortgage brokerage here in the UK, and
Yeah.
you've got a website. What is it?
Yeah, well, as you know, Jamie's Jamie Curran. I'm John Curran, and my company is currancy.co.uk. Currency Mortgage Brokers. And that's it. That's the website.
Currency.co.uk 100. So that's the website to go to if you're based in the UK. Currency with an ANCY.
Yeah, or if you're an expat who's living abroad and has got property in the UK and doesn't know what to do with it, or they've inherited some property in the UK, then anything to do with the UK we can help with.
Excellent. And you also know people all over the world that do this stuff. So if people want to get in touch with you, you could push them onto the right person, and it'd be somebody you would.
Exactly. I know. Well, we don't. I know you don't call them mortgage brokers in the US, but I've got contacts over there as well. People that I trust. So.
Well, there you go. There, if you trust me, then you should trust Ron. And if you're looking for a mortgage and it's in the UK, he's your man. And not only that, if you're anywhere else in Britain or anywhere else in the world looking to invest in property in the UK, or you currently have it and you're looking to manage that value of that property, or thinking about smart ways that you might be able to release that equity, then John can help you at www.currency.co.uk. And even if you're American looking to remortgage in America, John knows who to get in touch with. So check out that website, and if any of the three Curran brothers can ever help you, we're happy to do it. And you heard John say at the start there, people should reach out for free advice. And even if it's 3 years later, by the time you come back, and at that point you're able to act on it, then we'll still all be here 3 years later, and we're still eager to help. So check out that website, and thank you very much for watching the show. We had Larry earlier, we've got John now. I know which interview I preferred. It was with John. Thank you very much, John.
Oh, thank you very much, little bro.
Hey, it's me, the little bro. I don't get called that very often. Thank you very much, everybody. I'll see you tomorrow for more of the same. Remember, here on TradeSpotting, we never stop. Culture of excellence, and we support each other.